Well, hello everyone. Welcome to Getting Started with Options. My name is Barbara Armstrong, and we are back at week 1 in a 12-week rotation. I am delighted to be here with each and every one of you. I see some new names in the chat today. We have some of who I call the usual suspects who come in and have gone through this multiple times. And then we always have some people joining for the first time. So whether you're new or a seasoned veteran, I want to welcome you. Love some of the new names. Backroad Bob, for checkout too. Welcome, along with Riceberg and Ryan and Randy and Jack and Harry and the rest of the gang. Glad to have you all on board. We also have Mike Fairborn with us in the chat. He's a fellow coach, a friend. He understands all of these strategies inside and out. So if you have questions, please go ahead and ask, because if you have a question, chances are there are a dozen other people sitting there with the same question as well. So to my mind, the only poor question is a question that isn't asked. So I also invite you to follow us in the land of X, Barb Armstrong CS and Mike Fairborn CS. I want to get through our important information so we can get right down to business, because today we are starting with the basics, which means we're going to talk about buying puts, buying calls, and selling puts. And you may think like, well, if we have only two types of options, puts and calls, and the only thing we can do is buy or sell a call and buy or sell a put, why do we need 12 weeks? It's because we can put them together in lots of different combinations. But before we start putting them together in these different combo packs, it's important that we understand what each of the individual components does. And one of the things that's really appealed to me as an investor and a trader about options is that there are strategies that work well when the market goes up, or that are designed to work well when a stock goes up. There are strategies that are designed to work well when a stock or an index goes sideways. And there are options that are designed to work beautifully if a stock is falling. Now, what's the catch? The catch is that with many of these strategies, you could lose 100% of what you've invested. And so it's important that we understand, before we get captivated by what the potential can be, that we understand just how significant the downside can be as well. And trust me, that can also be significant. So let's get to our important information so we can get out to where the magic happens and understanding begins. So options carry a high level of risk. They're not suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We have to take transaction fees into account. When I talked about the downside with a long option, and long means buy. I do try to speak in English through this whole thing, but there are certain terms particular to trading. So when we buy an option, how much could we lose? All of it. All of it. So that's important to know. While we look at technical analysis, other approaches, including fundamental analysis, understanding what's happening with earnings, what's happening globally in the news, can provide an important perspective as well. Know that all investing involves risk, including the loss of principal. We use the paperMoney software application on the thinkorswim desktop platform. And this is all for educational purposes only. I always do at least one example in every class, but it's just that. It's an example. It's not a recommendation. So important to know that. One of the differences between that paperMoney account and a live account is that short options, or an option that's been sold, although it can be assigned at any time up until expiration, that will never happen in paperMoney. So we don't get to practice that in paperMoney. It can happen in a live account. Stop loss orders don't guarantee we'll get out at the price we've requested. Okay, so what are we going to look at here? And with options, why might a trader be interested in options? And there are a number of different reasons. So one might be, maybe you're approaching retirement and you've been at this for a very long time, and you want to hedge your risk. And hedge your risk, is a nice term. I tend to think of it as protecting your giant heap, protecting a heap that you have spent a lifetime creating. And, so it's important. So you might be looking for protective strategies, a way to protect, as I affectionately say, your giant heap. You might say, like, I wish I had a giant heap, Barb. I am just starting out. And so I am looking to generate some income. And I am looking, to add, because I'm just starting out, or maybe you're hitting retirement and you'd like an extra, $500 a month, or $1,000 a month, or $5,000 a month. I don't know what your situation is. So some people might just say an extra 100 a week. That would give me some play money to be able to go out for dinner, or an extra $1,000 a month would, be great vacation money, or, whatever that is. And you might want to use covered calls. There's a number of strategies that can be used to generate income that have defined risk, defined reward. And so, some might be looking for protection. Some might be looking to generate a weekly or a monthly income. And some, might say, I had a giant heap and I had to use it for something. And so I need to build another nest egg, or I'm just starting out, I'm in my 20s. And instead of the word speculation, which, there's nothing wrong with that word, but I kind of think of it more as I'm looking to grow. I'm looking for growth. I don't need this money right now, but I understand the importance of growth over time, and I'm looking to trade. And you can trade options in a conservative way. I am looking as a way to grow my account. And some might want to use something like a long call, which requires less of a financial investment, to buying stock perhaps. But there are, many strategies that we can use in the options world that can help us grow an account also. And so these are three of the reasons that a trader might consider using options, just since we're starting out here. Now, I think something worth spending a minute on is, well, what's the big diff? Because I have heard that options are really risky, compared to stocks. And the answer is yes and no. Have you looked at Weight Watchers lately? Because that stock lost a lot of weight. It went from being $100 a share to now, I think it's under $5 a share. Or Peloton. And, if you were going with a buy and hold strategy, or just recently, no one could have anticipated CrowdStrike, putting through a Microsoft update that had an error and causing global, mayhem. But it had a big impact on that stock. With stock, you own a piece of the company. It doesn't expire. And so if you have a stock that goes a whole lot of nowhere for 6 months, you haven't necessarily, that stock hasn't maybe increased in value, but it hasn't lost anything either. Where with an option, you have an expiration date. And so, if you are, say, buying a call, expecting the stock to go up and it doesn't, the stock is worth the same amount, but the option contract could expire and you could lose 100%. So when you have an option contract, you don't own stock. You just have that contract. And, but in order to control 100 shares of stock, you have to buy 100 shares of stock, and that costs more. When we use an option, it can cost us less, but the risk and reward ratio can be higher, but that cuts both ways. A stock can pay a dividend. Options do not. And, we pay a premium when we buy an option. There isn't a premium associated with buying a stock. It's just the cost of the stock. But, understand that, whether you are buying stock or trading an option, you want to have a set of rules or guidelines around that. And, you know, in my world, I want to know when I'm going to exit a position, whether the trade goes for me or against me, and that's whether it's a stock or an option. And if you don't take that position, you know, it can at times be humbling. But today, you know, our focus is obviously in the option arena, and so that's what we're talking about today. But I just wanted to take a minute and compare the two. Okay, so we're going to go over some basics, and then we're going to go out and we're going to place an options trade. And we're going to show how we can use these options depending on what we think is going to happen with a particular stock or a particular index. And we're going to talk about how option pricing is impacted. So before we get out and place an example order, we're going to come over here to a Word document. And, you know, some of you who have been with me for a long time remember the painful days of natural, what I affectionately call natural master, where I just kind of tried to draw everything freehand. But what we're going to do, and this is something that I actually learned from, just let me get my drawing tool going here, learned from a client, and I thought it was pretty brilliant. And that is, what they did is they would sit down, and if they were waiting for their kids to go out for dinner, they'd grab an envelope and flip it over, and they'd draw this grid. And they'd say, okay, what does it mean when I buy a call? And then what does it mean when I buy a put? And what does it mean? I'm going to have to make these just a little bit smaller. What does it mean when I sell a call? And then when we get to door number 4, I bet you can guess. And then what does it mean when I sell a put? Okay. And so here are the 4 things. Remember, we only have 2 types of options. We have calls and we have puts. And then we can either buy or sell a call, and we can buy or sell a put. That's it. So what's the big whoop? Well, there's actually a fair bit to it. Okay, so, you know, what does it mean? So what does it mean when I buy a put or buy a call? So that's the first question we have to ask ourselves. And then the second is, if I am going to trade this option, what direction am I expecting the stock to move? And then door number 3, or question number 3, is like, hey, how much risk am I taking? And then on the other side, how much can I make? What's my potential reward? Yes, and we can say long a call. So long a call means buy a call. And then what kind of impact does time have on our option? Is time our friend or our foe? And then the last thing, you know, it's not sing it, sister, it's draw it, sister. And for me, that's where this all kind of came together and started to make sense. So, what does it mean when I buy a call? When I buy a call, it gives me the right to buy the stock at the strike price from now until expiration. So if I buy a call, it gives me a right to buy the stock at the strike. Okay? What direction am I expecting the stock to go? Well, I'm expecting the stock to go up. And then how much am I risking if I buy a call? I am risking the entire premium. So you could say, like, I'm risking 100%, you know, but it's the entire premium. 100% of what you paid could be gone. And then how much can you make? Well, and this is an infinity sign, it's unlimited. And if we wanted to erase that, we could type in unlimited also. Let's see if I can erase that. Okay. I've only got my junior badge here on this drawing tool, but it's unlimited. And this is where people start thinking options look pretty amazing, right? When you start saying, wow, like this is unlimited, that's pretty cool. But is time our friend or our enemy? Time is working against us. So we have to be aware of that, and that can influence what strike we buy, or what expiration date we choose, because time is ticking away. Now, to draw it, we're going to look at, okay, we have a stock, it's moving up, pulls back maybe for a few days, starts to move up again, comes back, and we're thinking, hey, this looks like an uptrend. And I think this is going to keep going up. So what I'm going to do is I am going to buy a call. Maybe it's trading at, $49. So I am going to buy a call at $50. And maybe I paid $2 for this call. So I'm buying a call. Here's my natural master. Now, if all goes according to plan and it goes up as I'm expecting it to do, and it goes up, let's say it goes up to 60. Woohoo! Well, what is this option going to be worth? Well, the value of the option, remember, I have the right to buy the shares, okay? So I could exercise this call, my right to buy 100 shares at $50 and turn around and sell them at 60. So the value of this option, it's got to be worth at least $10, right? Because I have the right to buy shares at 50 and it's currently trading at 60. Now you might say, well, I don't even have a $5,000 account. I can afford to buy, a call for $2 a share, or $200 a contract, but I don't have $5,000 to buy $5,000 worth of stock. But so what many, or at least what some traders will do, they aren't interested in exercising their right to buy the shares. They just want to buy the call and turn around and sell it for a profit. Now, what if, lo and behold, can it be true, you're wrong and the stock goes down? Well, it doesn't have to go down very far. And as it approaches expiration, especially, let's just say it goes down to 45. Doesn't even go down by $10. It could go down to 49. And if it's at expiration, this is going to end up being worth less and ultimately worthless. It zero. So that's 100% loss. And either one of these can happen. Okay. Now, do we see something where we have a 400% return all the time? Often the types of trades that we are placing as example trades, that isn't our goal, but it could be. And every once in a while we can see, something like that happen. Now, have we seen zeros happen? We sure have. Okay. So let's come back over now to buying a put. So what if instead of buying a call, I buy a put? What does that mean? What am I getting myself into when I buy a put? Well, when I buy a put, it gives me, let's do this one in pink. It gives me the right to sell. So it gives me the right to sell the stock at the strike price at any time between when I buy the put and when I close out the trade. Now, what direction am I expecting it to go in? I'm expecting the stock to go down in value. And then, and feel free to play along and type in with me, what are we risking when we buy a put? How much could we lose when we buy a put? We could lose 100% of it, the entire premium that we paid to get in. And how much could we make? Well, I used to say it was huge, and it is huge, but that's not specific. But what ultimately we could make is the difference between the strike price minus the premium. So if in our example, and I'll go over what we could make, but if this example was a put and we bought the 50 strike and the stock went to zero and we paid $2 for it, we'd be up $48 a share, which is huge. So, and again, is time our friend? Is it working for us? No, it's working against us. It's chipping away at the value. So we want to get in and make our money and see this move dramatically and then get out before time chips away at the value of our option. And this is back where, with the stock thing, if the stock goes sideways, it doesn't chip away at the value of the stock like it does chip away at the value of an option. So here we are wanting the stock to go down in value, right? So let's say we're looking at a stock, it's downtrending, tries to recover, looks like it's going to start falling again. And we say, okay, I think this is going to continue to fall. So I am going to buy a put at 50. Now, in trader speak, we call that a long put. Long means buy. And if we're right, and let's say this falls and goes down to 40, and let's say we're staying with this analogy of I paid $2 to buy this put. Well, I now have the right to sell the shares at 50. So I could exercise this right to sell. I could go out and buy 100 shares at $40 a share, turn around, sell them at 50. And that is like there's dancing in the street, joy in the land, because you've just now made $1,000 less the $200 you paid to get into the trade. And again, some people may not want to buy the $4,000 worth of stock. They're just looking to buy the option for $2 and to sell it for a higher amount. And in this case, whether you exercise your option, buy the shares and then put it to someone, or just sell the option for a gain, the amount you make is going to be similar. Okay? Okay. Any questions on this? Yes, the max loss is the premium paid. And basically, this could be 100%. And so, and it doesn't, like as we approach expiration, it doesn't have to be dramatic. Like if it comes up to $52, well, what do we have? We have an option that gives us the right to sell at 50. Why would somebody want that if they could go out in the open market and sell their shares for 52? So, this is going to lose value and end up worth zero at expiration if it is trading above that strike. So, even though the gains can be big, the loss can be big too. It can be 100%. But if you position size appropriately and know that this is what your loss could be, then you're not going to blow up your account if that happens. Now, what about selling a call? And this is the one I struggle with the most, because we don't talk about selling naked calls in this class. But what does it mean to sell a call? What it means is we are creating an obligation. So when we have the right to buy when we buy a call. But, if things don't go according to plan, we can walk away and we know that the most we can lose is what we paid to get into the trade. Now we're creating an obligation An obligation to do what? An obligation to sell the stock at the strike at any time from the time you place the trade until expiration. And what we do talk about in this class is selling a covered call. So if you have 100 shares of stock, where might you sell that call? And we'll talk about that in a sec. But so if you own shares of a stock and maybe it pays a dividend, or maybe you inherited it from your grandmother or something, you know, and you think that it's been going sideways and it may continue to do that. Or maybe you could see it pulling back for a little bit, but longer term, you might be bullish on it. If it's a covered call, then you're kind of neutral to bearish in the short term. Okay, now what is your risk? Well, this is the one that kind of is sobering, because technically, if you don't own the stock, your risk is unlimited because you've committed to sell stock. And if you don't own it, let's say we're using that $50 number, what if news came out and that thing gapped up to 75? And somebody said, okay, you said you'd sell it to me at 50. I'm going to take you up on that. So now you have to go out and buy it at 75 and sell it at 50. That is very painful. So you're technically, your potential for loss is unlimited, and the most you can make is what you get paid to sell that call to get in. But, you know, if you're saying, well, now I'm thoroughly depressed, why would anybody ever want to do that? Well, one little benefit is that time is working for you, because if you're doing this and selling a covered call, you want to sell that call and then have it go down in value. And every day that you're in the call, it's chipping away at that value little bit by little bit. And so if you wanted to draw this out, let's say you own a stock and it's going sideways, or if you wanted to be, you know, speculative and take on this unlimited risk. But if it's kind of going sideways, you might say, you know what, I want to sell a call when it bounces off this resistance level. And I'm going to sell this call. Let's say it bounces here at 49. And then when it comes back down here, I'm going to buy it back. So maybe you sell it for 2 and you buy it back for 50 cents. And then it comes up and hits again and you sell another call and then buy it back. And if it continues to kind of go in the sideways range, you can kind of do a wash, rinse, repeat. Sell it when it bounces off resistance, buy it back. Okay? So this is an example of something that, you know, of how some might use selling calls with a stock they own that's going sideways. Okay? Okay, so here's door number 4. Now, what about selling a put? Okay, so when we sell a put, again, we're in the obligation category. Okay? We are creating an obligation. But it's an obligation to buy. So we're saying, hey, if you would like me to buy this stock at any time between now and expiration, I know this, at any time between now and expiration, it's starting to sound like a broken record, but that's the way these work. I'm happy to buy your shares. And so, you know, are we bullish? We're bullish, which means we're expecting the stock to go up or at least to go sideways. Okay? And how much could we lose? Again, I like the word huge, but it's not totally accurate. It's, again, the strike price. Because if I sell a put and I agree, say, hey, if you'd like me to buy this stock from you at $50, if it gets put to me at $50 and goes to 0, I'm in a world of hurt, aren't I? So it's basically the strike price. This is how much I could lose. It's not unlimited, but the strike minus the credit I got paid to get into the trade is what I can lose. So that's sobering. And the most I can make is this credit I got paid to get in. And then once again, time is ticking away. And time is my friend, even on Saturdays and Sundays and holidays. Now, am I bullish here? I'm bullish. So we could use this same chart here, or we could use the sideways chart, because it's bullish to neutral. So if something was going sideways, like this, you could say, hey, when it bounces off support, I'm going to sell a put right here. And then my goal is to buy it back when it gets here and close out the trade. And then if it comes back down, I'll sell another one. But, when it gets a little concerning is if it breaks down and then the stock gets put to you. And it could, if it was a crowd strike kind of moment, it could keep coming down. And then, there's tears, sadness, and with on the selling a call side, what if we've sold a call and then going back to this other, what if it broke out and then kept on going? Well, we'd have to sell. If this was at 50 and it took off, we're still selling. So if you know that under no circumstances would you ever want to part with your grandma's stock that you inherited, then don't sell a call, because you could end up being called out. Okay. Now, also with the put, if we're selling a put, it could look like, buying a call, where if something is uptrending, and let's just change the color, it's uptrending. So we say, hey, I think this is going to keep going up, so I am going to sell a put right here. Now, some people will sell a put because they do want to buy the stock. And so then they might sell it closer to where it's currently trading, or even a little bit in the money. But if you just wanted to make this $2 a share by selling this put at 50, when the stock is maybe trading at 51, and you're expecting it to keep going up, if it keeps going up, then the value of this put will fall, and eventually it'll become worth nothing. Okay? And you may not wait till it becomes nothing. You may say, hey, when I've got 80 or 90% of my max gain, or 50% of my max gain, I'm going to buy it back. But if things do not go according to plan and it goes down through your strike and now it's trading at 45, if you want to buy this back to take your risk off the table, you've sold a put saying you're willing to buy the stock at 50. It now has $5 worth of value, so it's probably going to cost you at least $5 to buy it back, maybe more, maybe $6. Maybe, if volatility's gone up, that can pump up the price if there's time value left. So, then, you're going to be sad, but you're taking your risk off the table. Okay. So, somebody's saying base hit's my favorite. Yeah. Well, we're going to talk about a base hit now. So I hope you guys have been taking notes, because I'm about to wipe this Etch-a-Sketch. I'm going to give it a shake. We're going to wipe it clean. And we're now going to go out and we're going to look at an example trade. And I think the easiest one to wrap your head around, at least the easiest one for me, was in the beginning buying a call, because that seemed, more similar to buying a stock. You want to buy something and have it go up in value and then sell it. And we can use calls in a variety of ways. So if we look here, this is Royal Caribbean. It came with earnings yesterday, or actually a few days ago. And, even though it pulled back on that day, it beat on earnings. And if we come over here and look at the live news, Macquarie adjusts their price target to 189 from 165. Susquehanna, these are analysts, are raising the price target to 180 from 160. Mizuho adjusts price target to 195 from 165, etc. So the analysts seem pretty gung-ho on Royal Caribbean. Now, are they right? Not always. So one of the strategies that I did a mini session example trading plan for was something called 1 ATR, and that's in an average day, this ATR that I put on the chart. If we come to studies and then edit studies, if you come down here to ATR or you type in ATR and we click on it, there's a little question mark and that'll give you a detailed definition. But the quick and dirty definition is this tells us the average true range or the amount over the last 14 days that this stock has moved in an average day from the very high of the day to the low of the day. I am not going to do a scan in today's class. So that we won't be covering today, Ken. This overview is, just has a lot of content in it. Okay, so there's our ATR. And what this is saying is, hey, over the last 14 days, on average, this stock has moved. It's about $4. If we look in the bottom left corner, it's moved about $4.90. So that's what we're going to use. And we're going to say, okay, well, today's high, what's today's high? Today's high, if we look in the top corner, it's 157.87. And today's low, 155.61. So if we come over here, and I'm going to scrunch this down, and we're going to switch this to a scratch pad. And we're going to use our RCL example, Royal Caribbean, the 1 ATR for this, the amount it moves in an average day over the last 14 days is $4.90. So our target when we buy our call is going to be today's high, that 157.87 plus $4.90. Which is 162.77. And then our exit, just in case it doesn't go according to plan, which it sometimes does not, that's 155.61 minus 490. So that's 150.71, I believe. And feel free to check my math on that. 155.61 minus 490, 150.71. So to put this trade in, we're going to put in both a target and an exit. Okay? And this is the thinkorswim desktop platform. And you know what? I will put a link in. If you haven't, Mike, and I put so many links in and I forgot to put this one in. If you're new to thinkorswim, you can book a one-on-one appointment with someone, to just help you set things up the way you want. The other thing is I created a number of mini sessions, but let's go in and put our trade in. So what we're going to do is we're going to come to the trade tab for RCL. Because time is an issue, the further out we go for an expiration date. So if we look at the August monthlies and, we're almost August, the time decay is 13 cents a day. And we're going to look at this 165 option. That's 9 cents a day on an option that only costs $1.20. So if we take a look at that, it's losing if it just stays still and goes nowhere. And let's assume we're paying $1.30. So if I take 9 cents and divide that by $1.30, it's losing 6.9% a day just due to time decay. Where if we come out to September, it's losing 7 cents a day, the same 165 strike. It's losing 7 cents a day on a $4.40 price. Okay, So if I say, okay, 7 cents, so it's not just the finite number, it's as a percentage of the option. And if I divide that by 440, that's 1.5%. So time decay, it's a thing and it's important. And so even though we only intend to be in this trade for maybe a week, we'd rather not lose, if we're in it for 7 days, we'd lose like 70% of the option value just in time decay. Like that's not very sexy, is it? So we're going to come out here to September and we're going to pay more for the option, and substantially more. But the reason we're paying more is we have more time and we're trying to manage the damage potentially from time decay. And so if you look at the example trading plan, and I'll show that to you, it's in the trade management mini sessions. We want to have at least 1 million shares a day on the stock. When we come out, and I'm going to have to change this, we're looking for what we call a tight bid-ask spread. So we want this to be less than 10%, so less than 44 cents. It's 15, so we're good to go there. The other thing that we want is, if I change this to Barb's Basics, we can see that we have 500 contracts, and our guideline is we want to have at least 20 times the number of contracts we're going to trade, and we're only going to do one contract because we don't want to risk more than $500. So we're going to come out to buy, and we're going to just buy a single, and then we're going to come down to advanced orders and change our single order to first trigger sequence. We're going to right click and create an opposite order. And we're going to make this a market order because we know when we want to get out. We just don't know quite what the value of the option is going to be. And we'll talk more about how we might have a better handle on what that value might be next week. But our target is, if this stock, RCL, Royal Caribbean, goes above 162.77, we want to get out. And if it doesn't go according to plan and goes below 150.71, we also want to get out. So we're going to hit save. And when we come to confirm and send, this will do some of the calculating for us. One, it's saying, hey, you could lose the whole $404.45 or $445. You could lose all of it. Check. We understand that. Plus, there's a 65-cent transaction fee. We don't intend to be in this long. We want to be in it only until it goes up and hits our target at 162.77. And currently it's at 156. So it's about a $6 move. Or if it goes below 150.71, we want out. We're going to come down here and put this in our long call bucket and put in the notes that this is a 1 ATR target. Fire in the hole. And just because we put in that target and exit does not mean that we are absolutely going to get out at exactly that price. If the stock were to gap up or gap down, we could be out, when the stock hits a different price. And this is why we position size for max loss. Okay, so it's time to wrap it up. Our 45 minutes has come and it has gone. We'll look at how we manage a trade like this, but I just wanted to show you a couple of quick things. I've put a bunch of links in. One is I have this series, and you're going to want to hit subscribe, bottom right corner, to the channel. And there is an example trading plan for the long calls with that 1 ATR target. So you may want to watch that. That goes into a lot more detail. It's about 18 minutes. And then I have a bunch of, because I've seen some notes in the chat, people talking about being new to thinkorswim. So if you want to see how to customize a chart, 10 minutes. How to customize a watch list, 8 minutes. How to customize your monitor tab. How to add a script, how to use notes, how to customize the option chain, all that kind of stuff. So you want to be aware of that. If you're sick of binging Netflix and you'd like to binge some educational content, you can come down to this playlist, and I'll put a link to that in the show notes. And, we start with week 1, the basics, and we go through 10 different strategies over 12 different weeks. Okay. And the idea is at the end of all of this that you have an idea of which strategies might be most appealing to you. So check, we've done intro to options. Come back next week. We're going to spend the whole class talking about long calls. So here's my ask of you. 1, subscribe to the channel. 2, if you haven't hit the like button yet, if you would do me a favor and hit the like button, it lets us know, Mike and I, that you found this content valuable, but it helps more people find this content by moving things up in the YouTube algorithms. Also, please follow us in the land of X, Barb Armstrong CS and Mike Fairborn CS. You'll be glad you did. I don't believe there is a survey today, but if there's something you would like to see in an upcoming class, just let me know. Or something that I didn't cover about the basics that you would like me to cover, and I will do my best to work that into upcoming webcasts. So guys, thank you so much for joining me. Thanks to the guys behind the scenes for helping bring this to life. Thanks to Mike Fairborn. You guys kept him very busy in the chat. And thanks to each and every one of you for investing in your future. I'm sure your future self and your families will appreciate it. Up next, Connie Hill talking trading breakouts, filling in, or trading flag patterns. She's filling in for Ben Watson today. Take care, everyone. Bye for now.